VYM's 61-day crash recovery crushed VT's brutal 474-day wait. That's the difference between resilience and panic. Now let's shift gears and look at VYM crushed VT with an 81% 5-year return. That's the kind of commanding lead that separates winners from the rest. But here's where it gets interesting. VT lagged with 69% returns, a 12-point gap that compounds into serious money over 5 years of investing. In plain English, VYM took the checkered flag in this 5-year race. Think race cars, same track, but some engines just run faster. Over 5 years, VYM's performance left the competition in the dust. VT's 25% return over 12 months shows strong recent momentum. That's the kind of performance that turns heads. Here's where the story takes a turn. VYM delivered a solid 17% return over 12 months, though shorter time frames showed different results worth examining closely. Let's break this down further. VYM crushed it lately with a 6% quarterly gain. Dividend stocks showing real muscle when markets favor steady income plays. VT matched that performance almost perfectly at 4.8% over 3 months, showing how momentum shifts between these funds throughout the year. In plain English, VYM's steady pacing delivered better overall results, while VT had those explosive middle stretches. It's like comparing marathon strategies, consistent endurance versus bursts of speed at different points in the race. Let's dig into the details. VT's 1-year Sharpe of 1.2 shows solid risk-adjusted returns. You're getting decent bang for your buck short-term. Here's where things get revealing. VYM's Sharpe ratio hit 0.9. Decent risk-adjusted returns, but definitely leaving some efficiency on the table here. Now let's put this in perspective. VYM's 0.7 Sharpe ratio shows solid risk-adjusted returns over 5 years, balancing gains against volatility even through recent rough patches. But wait, there's more to this story. VT's Sharpe ratio of 0.5 means you're getting less bang for your buck when converting volatility into actual gains. In plain English, the Sharpe ratio is your risk efficiency gauge, like checking miles per gallon in a car engine. VT gives you better bang for your buck short term, while VYM shines over longer stretches. Let's take a closer look. VT's Sortino ratio hit 1.5, showing solid returns while keeping downside risk under control. Exactly what cautious investors want to see. Now here's where it gets tricky. VYM's 1.1 Sortino shows decent downside protection, but it's not quite managing those losses as tightly as you'd want. But that's not the whole picture. VYM's worst 5-year drawdown was just 16%. That's remarkably stable protection when everything else is crashing around you. Let's see how this plays out. VT's worst drop hit 26%, 10 percentage points deeper than something milder. That's a significant crash to stomach during downturns. In plain English, maximum drawdown shows how far your investment can sink before recovering. Using the swimming pool analogy, VYM kept you waiting safely in the shallow end, while VT dragged you down into the deep end. Now let's connect the dots. VYM bounced back from its worst drop in just 61 days. That's incredibly fast healing for a dividend fund. But hold on a second. That's over a year underwater. Watching your money stuck below break-even for 474 days tests even patient investors' nerves. Let's unpack this a bit. VYM bounced back in just 2 months while VT took over 15 months. That's the difference between resilience and prolonged recovery. Here's the key takeaway. Before we reveal the winner, what's your prediction? VT or VYM takes this battle? In plain English, recovery time's like watching plants grow back after winter. VYM's focused portfolio sprouts new leaves fast, while VT's global diversity takes a full season to fully regrow. But here's where it gets interesting. VYM's delivering a solid 2.4% dividend yield annually. That's reliable income hitting your account every quarter without selling shares. Let's get into the weeds here. VT delivers a solid 1.8% dividend yield. Not the highest payout, but respectable income while you're capturing global market growth. Let's zoom in on this. VYM's 2.4% yield beats VT's 1.8%. That's 33% more income hitting your account every year, compounding over decades. But here's where it gets interesting. VT's been rewarding shareholders nicely. Dividends growing 10% annually over 3 years shows solid commitment to returning cash to investors. Meanwhile, VYM's dividends grew at nearly 4% annually. Slower growth, sure, but you're starting with a much higher yield here. In plain English, VYM's like ordering a pizza that's already sliced and ready to eat. Instant satisfaction. VT's more like making your own dough. Takes longer, but you'll get more slices down the road. Here's where the story takes a turn. VT owns nearly 10,000 stocks across the globe. That's about as diversified as you can possibly get in one fund. Let's break this down further. VYM's focused on quality over quantity here. Just 569 stocks, all carefully selected for their strong dividend payouts. Here's where the story takes a turn. VT's nearly 10,000 holdings dwarf VYM's under 600. One spreads risk globally, the other bets on dividend champions selectively. Now for the real question. VT gives you real global exposure. 38% of your money works outside US borders, capturing opportunities worldwide. Let's dig into the details. VYM keeps it home with just 1.7% international exposure, nearly pure American dividend stocks for your portfolio. Here's where things get revealing. VT's got 38% international exposure, while VYM keeps 98% in America. That's a massive difference in how they handle geographic risk. Now let's put this in perspective. VYM's 5-year win and faster crash recovery show stability, while VT's recent 25% gains reveal short-term strength. Income seekers get VYM's 2.4% yield now, but VT's 10% dividend growth promises future income. In plain English, VT's like that friend who can't sleep until they've tried every restaurant in town, spread across 50 countries. VYM, they found their favorite local spot and never left. Here's the thing though, VT's loading up a quarter of its portfolio into tech. That's some serious commitment to growth-oriented companies right there. Let's take a closer look. VYM's light tech weighting at just 17% shows you what dividend investing really means. Prioritizing income over chasing growth stories. Now here's where it gets tricky. VT's 26% tech weighting versus VYM 17% creates a 9-point gap that's been driving VT's stronger recent performance in tech rallies. But that's not the whole picture. VYM loads up 22% in financials. Banks and insurers deliver those steady dividend checks that income investors love. Let's see how this plays out. VT keeps just 17% in financials, spreading risk across way more sectors instead of putting all your eggs in one basket. In plain English, think of it like couch change. VYM stuffs more coins into the bank and dividend pocket, while VT loads up the tech compartment. Same wallet, totally different loose change strategy. Now let's connect the dots. VYM loads up 22% in financials versus VT's 17%. That 5-point tilt helped cushion downturns and recover faster. But hold on a second. Identical expense ratios at 0.06% mean you're choosing between these funds on performance and strategy, not on cost savings. Let's unpack this a bit. At just $6 a year on 10 grand, this expense ratio is so low that cost basically disappears from your decision. In plain English, here's expense equality explained. Think of it like a car engine where both vehicles burn the same amount of fuel per mile. You're choosing based on performance and destination, not gas efficiency. Now let's flip the script. VYM's dividend strategy delivered an 81% 5-year return and bounced back faster from crashes than typical funds. But there's a catch. VT's 25% return shows how global reach and tech exposure crushed VYM's dividend-focused strategy in capturing recent momentum. Let's get into the weeds here. VYM bounced back in just 61 days while VT took 474. That's over a year of waiting versus 2 months. In plain English, here's the thing about recovery periods. When you're young and earning, you've got time on your side. But if you're retired and pulling from savings, those 474 days underwater could absolutely devastate your retirement plan. But here's where it gets interesting. VYM's 16% max drawdown beats VT's 26% crash. That's 10 percentage points less pain when markets collapse. Let's zoom in on this. VT's Sharpe ratio of 1.2 crushes VYM's 0.9. Global diversification delivers better risk-adjusted returns over the past year. Let's break this down further. VYM's Sharpe ratio of 0.7 crushes VT's 0.5. Dividend stocks delivered way better risk-adjusted returns over 5 years. Here's where the story takes a turn. VYM's 2.4% dividend yield beats VT's 1.8%. That's 33% more income hitting your account every quarter for retirees. In plain English, think of it like couch change. VYM hands you more coins to spend right now, while VT gives fewer today, but they multiply faster over time. Different life stages, different needs. But here's where it gets tricky. VT's 10% dividend growth crushes VYM's 3.7%, meaning your income snowballs much faster with global market exposure over time. Now for the real question. With nearly 10,000 stocks, VT spreads your risk so thin that no single company failure can sink your portfolio. Let's dig into the details. VYM keeps it selective with just 569 holdings. Quality over quantity, targeting only the most reliable dividend-paying companies out there. Here's where things get revealing. VT gives you 38% international exposure, while VYM's stuck at just 1.7%. Real global diversification versus America-only bets. In plain English, here's the home bias difference. VYM's all in on US stocks. Like betting everything on one country's economy. VT spreads that risk globally. If America stumbles, you'll feel it very differently. But wait, there's more to this story. VT's 26% tech allocation beat VYM 17%, and that 9-point difference explains why VT crushed it during the growth rally. Here's the thing though. VYM's 22% financial weighting versus VT's 17% gives it extra stability. Banks and insurers keep paying dividends even when markets wobble. Now let's connect the dots. VYM chases dividend payers while VT takes the whole market. Those sector bets explain why their performance diverges so dramatically. Now here's where it gets tricky. Identical expense ratios here. Both charge 0.06%. Cost won't decide this battle, so your choice comes down purely to strategy preference. In plain English, here's the bottom line. Both ETFs deliver similar efficiency, so your choice really comes down to whether you need durability for rough markets or raw performance for speed. Think race cars. Different tracks, different winners. Let's see how this plays out. So which fund fits you? VYMs for income seekers with shorter horizons, while VTs for aggressive long-term global growth. In plain English, think marathon runner picking your race. Need that finish line in 10 years with steady income now? VYM's your pick. Training for decades ahead with global growth? VT wins the long game. Now let's connect the dots, and that's a wrap. Remember, all investing carries risk, so do your homework first. But hold on a second. If you enjoyed this deep dive, hit subscribe for weekly breakdowns showing which funds actually deliver the wins you're after.